Hello and welcome back to the channel, where we dive deep into the fascinating world of hard-to-borrow stocks and potential short squeezes. Today, we're putting a specific name under the microscope, one that's been flagged by our proprietary screener for extreme cost-to-borrow fees and a rapidly dwindling supply of shares. We're talking about Zhongchao Inc., ticker symbol ZCMD. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Zhongchao Inc., or ZCMD, operates in the healthcare and health information services sector, specifically within the People's Republic of China. The company provides healthcare information, education, and training services primarily under its MD branch, and also has a segment for sales of patented drugs. This is a microcap company with a market capitalization of just $2.03 million. Let's look at the recent price action. ZCMD has had a tumultuous ride lately. Today alone, it's down 19.20%. However, looking back just 5 trading days, the stock was up a staggering 81.98%. Zooming out further, over the last 30 days, ZCMD is down 98.60%. Chart today's 5-day, 30-day performance highlighted this kind of volatility is often characteristic of microcap stocks, especially those that appear on our hard-to-borrow screener. What is cost to borrow and why it matters? At the heart of any potential short squeeze is the cost to borrow, or CTB. This is the annualized fee that short sellers must pay to borrow shares before they can sell them. Think of it as interest on a loan, but instead of money, you're borrowing stock. When the cost to borrow is high, it tells us two critical things: either there's a huge demand from people wanting to short the stock, or, more commonly in these extreme cases, there's a very limited supply of shares available to borrow. When fees exceed 100% annually, it means borrowing a share for a full year would literally cost more than the share's current value in fees alone. Why the stock is hard to borrow right now. Now let's talk about why Zhongchao Inc. ZCMD is on our radar. Our screener shows the annualized cost to borrow for ZCMD currently sitting at an astonishing 915.9%. Yes, you heard that right, over 900%. Highlight 915.9%. What's even more striking is the momentum behind this fee. It has shot up by 781 percentage points over the last 5 trading days. This isn't a gradual climb, it's a vertical spike. To add to this, the number of shares currently available to borrow is a mere 60,000, against an estimated float of 1.1 million shares. This extremely low supply, combined with the exorbitant borrowing fee and its rapid increase, gives ZCMD a composite squeeze score on our internal scale of 69.4. This indicates a significant confluence of factors suggesting it's indeed hard and expensive to short this stock. Squeeze mechanics explained. So, what does it mean when a stock like ZCMD is hard to borrow, and what are the mechanics of a short squeeze? A short squeeze happens when the price of a heavily shorted stock rapidly increases, forcing short sellers to buy back shares to cover their positions and limit their losses. In ZCMD's case, with shares costing over 900% to borrow annually, short sellers are facing an incredibly expensive gamble. If the stock price begins to climb, these short sellers are hit with a double whammy, mounting paper losses on their positions and a rapidly increasing cost just to maintain those positions. This pressure can force them to capitulate and buy back shares, which then adds buying pressure, driving the price even higher and creating a feedback loop. However, it's crucial to understand that a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have incredibly strong conviction in their bearish thesis and are willing to pay these high fees. Dilution risk check. One of the biggest threats to any short squeeze thesis is dilution. When a company issues new shares, it increases the total number of shares outstanding, which can flood the market and absorb any buying pressure, thus negating a potential squeeze. For ZCMD, our dilution risk check shows good news. We found no recent dilutive SEC filings like S-1s, S-3s, or 424Bs in the last 90 days. This means there isn't an immediate, obvious overhang of new shares hitting the market that could undermine a squeeze. Recent reverse split watch. It's also important to note that ZCMD executed a 1-for-3 reverse stock split on June 29, which was just 10 days ago. A reverse split reduces the number of outstanding shares and, in theory, increases the price per share proportionally. For microcaps like ZCMD, reverse splits often reduce the float to set the share price higher, sometimes as a strategy to meet exchange listing requirements or to make the stock appear more substantial. Historically, many microcap stocks tend to see renewed volatility or even a price pop within about a month after a reverse split, though this is a pattern observed in some names and certainly not a guarantee for ZCMD. It's an interesting variable to consider when watching this stock in the coming weeks. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Given ZCMD's unique setup, here's what we'd be watching for. Firstly, continued elevated cost to borrow levels and any further spikes in momentum. Secondly, the shrinking supply of available shares to borrow, which currently stands at just 60,000. Thirdly, volume. Today's volume was 552,400 shares, which is only 0.2 times its 30-day average volume of 3,579,750 shares. A significant increase in volume, particularly on upward price movement, would be a strong indicator of increased buying interest, which is critical for any squeeze. And finally, keep an eye on ZCMD's price action in the next few weeks, observing if it follows any of those historical patterns seen in microcaps post-reverse split. Jomcho Inc. ZCMD presents an interesting case study with its astronomical 915.9% cost to borrow, rapidly increasing CTB momentum, and extremely limited borrowable shares. While these are compelling factors for a hard-to-borrow stock, remember that risk is inherent, and a high CTB does not guarantee a short squeeze. Always conduct your own thorough due diligence. If you found this deep dive into ZCMD helpful, please hit that like button, subscribe for more unique stock analysis, and let us know your thoughts on ZCMD or any other hard-to-borrow stocks in the comments below.